In the dynamic world of trading, knowledge is power. Traders are always seeking an edge, a way to decipher the market's cryptic language. One such powerful tool, often overlooked, is volume analysis. It offers invaluable insights into the true story behind price movements. Imagine volume as the heartbeat of the market. A strong heartbeat often indicates robust health, while a weak one might signal underlying issues. Volume analysis provides a lens to view the strength and conviction behind price trends. It acts as a confirmation tool, validating or challenging the signals given by price action alone. Understanding volume can be the difference between riding a powerful wave of profit or getting swept away by a sudden market shift. Think of it like this. Price tells you where the market is going, but volume tells you how it's getting there and how strong the momentum is. By mastering the art of volume analysis, you gain a significant advantage, making more informed trading decisions and navigating the market with greater confidence. Are you ready to unlock the secrets hidden within the volume bars? Let's dive in. Volume analysis, at its core, is the study of trading volume in relation to price movements. It's a powerful tool for confirming trends, identifying potential reversals, and gauging the strength of price movements. High volume during an uptrend, for instance, often confirms the strength of the rally, suggesting strong buying pressure. Conversely, low volume during an uptrend might signal waning interest, hinting at a potential reversal. Think of volume as a measure of market participation and conviction. When more participants are actively buying or selling a stock, the volume increases. This increase in volume often coincides with significant price moves. By analyzing volume patterns, traders can gain valuable insights into the underlying forces driving the market. Volume analysis provides a crucial layer of context to price action. It helps traders differentiate between fleeting price fluctuations and sustained trends backed by strong conviction. This ability to separate noise from genuine signals is invaluable in making profitable trading decisions. In the next section, we'll delve into real-world examples using Nifty 50 stocks, demonstrating how volume analysis can be applied in practical trading scenarios. Let's bring volume analysis to life with real-world examples from the Nifty 50, focusing on two prominent players, Reliance Industries and Infosys. These companies are giants in their respective sectors and provide excellent case studies for understanding the dynamics of volume and price action in the stock market. Imagine you're analyzing a price chart for Reliance Industries. This conglomerate has a diverse portfolio ranging from petrochemicals to telecommunications, making it a significant player in the market. You notice a steady uptrend over the past few weeks. The stock price has been climbing consistently, reflecting positive investor sentiment and strong performance indicators. This upward price movement is accompanied by consistently high trading volume. High volume during an uptrend often suggests that institutional investors are accumulating shares, adding credibility to the price increase. This combination is a strong bullish signal, indicating strong buying pressure and confidence in the stock's upward trajectory. Investors are optimistic about the company's future prospects, driving the stock higher. Now, let's shift our focus to Infosys. This IT services giant is another heavyweight in the Nifty 50, known for its innovation and global reach. The stock has been experiencing a downtrend, with the price steadily declining. This could be due to various factors such as market conditions, company performance, or broader economic trends. However, you observe a sudden surge in volume accompanying a significant price drop. This spike in volume during a downtrend can be a critical indicator. This could indicate a climax of selling pressure, potentially signaling a reversal and a possible buying opportunity for astute traders. When volume spikes during a price drop, it often means that the selling may be exhausted and the stock could be poised for a rebound. These examples highlight how volume analysis provides valuable context to price action. By examining volume alongside price movements, traders can gain insights into the strength and sustainability of trends. By observing the relationship between price and volume, we can gain a deeper understanding of the underlying market sentiment and identify potential trading opportunities. Volume acts as a confirmation tool, helping traders validate the direction and momentum of price movements. Remember, volume analysis is most effective when used in conjunction with other technical and fundamental analysis tools. Combining volume with indicators like moving averages, RSI, and MACD can provide a more comprehensive view of the market. It's like adding another layer of confirmation to your trading decisions, increasing your chances of success. By integrating volume analysis into your trading strategy, you can make more informed decisions and enhance your overall trading performance. Section 4. Volume speaks volumes, deciphering price movement signals. Volume acts as a powerful confirmation tool, validating or challenging the signals given by price action alone. It serves as the market's voice, providing context to the price movements we observe on the charts. When volume aligns with price movements, it strengthens the signal, indicating strong conviction behind the move. This alignment suggests that the market participants are in agreement, adding weight to the observed trend. Conversely, when volume diverges from price action, it raises a red flag, suggesting a potential weakness in the trend. This divergence can be a critical warning sign for traders, indicating that the current price movement may lack the necessary support to sustain itself. For instance, imagine a stock experiencing a significant price surge, but the volume remains weak. This scenario often points to a lack of genuine buying interest, which can be a precursor to a reversal or a short-lived rally. This divergence could signal a lack of genuine buying interest, suggesting the rally might be unsustainable. Traders should be cautious in such situations, as the apparent strength in price may not be backed by solid market participation. This is often referred to as a weak rally. In such cases, the price increase is not supported by a corresponding increase in volume, indicating that the upward movement may not have the momentum to continue. Conversely, a significant price drop on low volume might indicate a lack of selling pressure and a potential buying opportunity for savvy traders. This scenario suggests that the downward movement may not be as strong as it appears, providing a potential entry point for those looking to buy. Volume spikes, often represented by unusually tall volume bars on a chart, can provide valuable insights into market sentiment. These spikes are moments of heightened activity, revealing the intensity of buying or selling pressure at specific points in time. A large spike in volume during an uptrend, for instance, often indicates strong buying pressure and a potential continuation of the rally. This surge in volume confirms that the upward movement is supported by significant market interest. Conversely, a large volume spike during a downtrend might signal a climax of selling pressure, potentially hinting at a reversal. This can be a critical point for traders to watch, as it may indicate that the selling has reached its peak and a change in direction could be imminent. By carefully observing volume patterns and their relationship to price action, traders can gain valuable insights into the underlying market dynamics and make more informed trading decisions. Understanding these patterns allows traders to anticipate potential market moves and adjust their strategies accordingly. Remember, volume analysis is like listening to the market's whispers, helping you decipher the story behind the price movements. It provides a deeper understanding of the market's behavior, enabling traders to navigate the complexities of trading with greater confidence and precision. Section 5. Spotting the turning tide. Volume as a reversal indicator. One of the most valuable applications of volume analysis lies in its ability to identify potential trend reversals. Volume, the number of shares or contracts traded in a security or market, can provide critical insights into the strength or weakness of a price move. By recognizing volume patterns that often precede market shifts, traders can position themselves for potentially profitable trades. Understanding these patterns can be the difference between capitalizing on a market move or missing out entirely. A classic example is the volume climax. This occurs when there is a significant increase in volume, often accompanied by a sharp price movement. Imagine a stock experiencing a prolonged downtrend. The price has been steadily declining, and traders are growing increasingly pessimistic. Suddenly, the price plummets on an unusually high volume day, signaling a potential selling climax. This dramatic increase in volume suggests that many traders are capitulating, selling off their positions in a panic. This surge in volume, coupled with the sharp price decline, suggests that panic selling might be driving the market. The intense selling pressure can often lead to an exhaustion point. This exhaustion of selling pressure can often mark a bottom, presenting a potential buying opportunity for astute traders. Recognizing this pattern can allow traders to enter the market at a favorable price point. Conversely, during a strong uptrend, a significant price increase on low volume might signal a lack of buying conviction, potentially indicating a weakening trend. This lack of volume support suggests that the upward momentum may not be sustainable. This divergence between price and volume could be a warning sign of an impending reversal. Traders need to be cautious and look for additional confirmation before making any trading decisions. Traders often look for confirmation from other technical indicators, such as candlestick patterns or momentum oscillators, to validate the signals provided by volume analysis. These additional tools can help confirm whether a reversal is likely to occur. Remember, no single indicator is foolproof, and a confluence of signals often provides the highest probability of success. Combining volume analysis with other technical indicators can enhance the accuracy of your trading decisions. By mastering the art of reading volume patterns and their implications for trend reversals, traders can gain a significant edge in the market, capitalizing on potential shifts in market sentiment. This skill can lead to more informed and profitable trading strategies, ultimately contributing to long-term success in the financial markets.